My name is Kim Lawson. I'm a senior tax analyst with the Small Business Self-Employed Division within the IRS. I would like to welcome everyone to the webinar today. Our webinar is titled Business Taxes for the Self-Employed, the Basics. This webinar is designed for new small business owners and self-employed people. I hope you will find this presentation both helpful and informative. We would also like to welcome any participants representing the news media. If you are with the media, please send us an email message at sbse.webinars@irs.gov with your contact information. Our media relations staff can answer any questions you might have following the presentation. Today, we're going to talk about what you need to know to meet your federal tax obligations as a self-employed person. We'll be talking about two IRS forms, Form 1040, Schedule C, Profit or Loss from Business, Sole Proprietorship, and Schedule C, Easy, Net Profit from Business, Sole Proprietorship. These are the forms used to report income or loss from a business you operated or a profession you practiced as a sole proprietor. We'll also briefly talk about Form 1040, Schedule SE, Self-Employment Tax. Schedule SE is used to figure tax due on net earnings from self-employment. Other topics related to being self-employed will also be discussed in this webinar. Everything we talk about, from forms, instructions, publications, and web pages, is available on the irs.gov website. So don't worry about taking notes. Just jot down any questions you may have, and by the end of this webinar, you'll know where to look for answers to your federal tax questions. But in case you have a question you would like to have an answer now, we'll also have a question and answer session at the end of the presentation. You can ask questions during the webinar by clicking the Ask a Question link under the PowerPoint window and selecting the Submit button. At the end of the presentation, a team of subject matter experts will respond to your questions about small business taxes for the self-employed, the basics. Also, we will only be answering general topic questions related to the information presented today. We ask that you not ask case-specific questions, as we will not be able to provide guidance in this forum. Please avoid revealing any sensitive or identifying information that might disclose improper information about you, your business, your clients, or anyone else. For your convenience, we have provided you with a PDF file of this presentation to download and print. This program will be archived on our website at www.irs.gov for later viewing. Now let's get started with the presentation. If you are in business for yourself, or you carry on a trade or business as a sole proprietor or an independent contractor, you generally would consider yourself self-employed, and you would file IRS Schedule C or CEZ with your Form 1040. Here are 6 things the IRS wants you to know about self-employment. Number 1, self-employment can include work in addition to your regular full-time business activities, such as part-time work you do at home or in addition to your regular job. Number 2, if you are self-employed, you generally have to pay self-employment tax. Self-employment tax is Social Security and Medicare. It is similar to the Social Security and Medicare taxes withheld from the pay of most wage earners. You figure SE tax yourself using a Form 1040 Schedule SE. Also, you can deduct half of your self-employment tax in figuring your adjusted gross income. Number 3, if you are self-employed, you generally have to make estimated tax payments. This applies even if you also have a full-time or part-time job and your employer withholds taxes from your wages. Estimated tax is the method used to pay tax on income that is not subject to withholding. If you don't make quarterly payments, you may be penalized for underpayment at the end of the tax year. Number 4, you can deduct the cost of operating your business. These costs are known as business expenses. These are costs you do not have to capitalize or include in the cost of goods sold, but can deduct in the current year. Number 5, To be deductible, a business expense must be both ordinary and necessary. An ordinary expense is one that is common and accepted in your field of business. A necessary expense is one that is helpful and appropriate for your business. In addition, you must be able to substantiate your expenses. Therefore, it's important to keep good records. Number 6. For information, see the Self-Employed Individuals Tax Center on irs.gov. Generally, you are self-employed if any one of the following apply to you. You carry on a trade or business as a sole proprietor or an independent contractor, or you are otherwise in business for yourself, including a part-time business. A sole proprietor is someone who owns an unincorporated business by himself or herself. People such as doctors, daycare providers, mechanics, and contractors who are in an independent trade, business, or profession in which they offer their services to the general public are generally considered independent contractors. However, whether these people are independent contractors or employees depends on the facts in each case. The general rule is that an individual is an independent contractor if the payer has the right to control or direct only the result of the work and not what will be done and how it will be done. The earnings of a person who is working as an independent contractor are subject to self-employment tax. A trade or business is generally an activity operated to make a living or in good faith to make a profit. These facts and circumstances of each case determines whether or not an activity is a trade or business. Regular activities and transactions that produce income are important elements. You do not need to actually make a profit to be in a trade or business as long as you have a profit motive. You do need, however, to make ongoing efforts to be profitable. You do not have to carry on a regular full-time business activities to be self-employed. Having a part-time business in addition to your regular job may be considered self-employment. For example, you are employed full-time as an engineer at the local plant and you fix televisions and radios during the weekends. You have your own shop, equipment, and tools. You get your customers from advertising and word of mouth. You are considered to be self-employed as the owner of a part-time repair shop. As a self-employed individual, generally you are required to file an annual federal tax return and pay estimated tax quarterly. Quarterly estimated tax payments are due on the following dates: April 15th, June 15th, September 15th, and January 15th. Self-employed individuals generally must pay self-employment tax as well as income tax. SE is a Social Security and Medicare tax primarily for individuals who work for themselves. It is similar to the Social Security and Medicare taxes withheld from the pay of most wage earners. In general, any time the wording self-employment tax is used, it only refers to Social Security and Medicare taxes and not any other tax, like income tax. Before you can determine if you are subject to self-employment tax and income tax, you must figure your net profit or net loss from your business. You do this by subtracting your business expenses from your business income. If your expenses are less than your income, the difference is net profit and becomes part of your income on page 1 of Form 1040. If your expenses are more than your income, the difference is a net loss. You usually can deduct your loss from gross income on page 1 of Form 1040. But in some situations, your loss is limited. See Pub 334, the Tax Guide for Small Business for individuals who use Schedule C, or see Easy for more information. You have to file an income tax return if your net earnings from self-employment were $400 or more. If your net earnings from self-employment were less than $400, you still have to file an income tax return if you meet any other filing requirement listed in the Form 1040 instructions. So what if you work for somebody else and you're also self-employed? If, in addition to your self-employment income, you receive wages, then subtract those wages from your total income to figure out how much self-employment income is subject to the taxes. If you have income subject to self-employment tax, you figure the tax on Schedule SE. If you have more than one business, use one Schedule SE and combine the profits and losses from all of your businesses. As a business owner, you may be required to get a federal employer identification number, commonly referred to as the EIN. The EIN identifies tax returns filed with the IRS. If you don't have an EIN, you need to get one if you pay wages to employees, have a self-employed retirement plan, operate your business as a corporation or partnership, or are required to file any of these tax returns: employment, excise, fiduciary, or alcohol and tobacco and firearms. If you are a sole proprietor with no employees and don't meet any of these requirements, you don't need an EIN for dealing with the IRS. But you may need one for dealing with other businesses, including banks that require an EIN to set up business accounts. The IRS will give you an EIN even if you don't need it for IRS purposes. Let's look at the application process. The easiest and fastest way to get an EIN is online by selecting the EIN link at www.irs.gov/businesses/small. The EIN is issued immediately once the application information is validated. You can also get an EIN by telephone by dialing 1-800-829-4933 from 7 o'clock a.m. to 10 o'clock p.m. in your local time zone. EINs can also be obtained by mailing or faxing Form SS-4, Application for Employer Identification Number. See the form instructions for details. If you don't need an EIN, generally you use your SSN as your taxpayer identification number. You must put this number on each of your individual income tax forms, such as Form 1040 and its schedules. If you must have an EIN, include it along with your SSN on your Schedule C or CEZ. Let's talk about how to pay your federal taxes. The Electronic Federal Tax Payment System is a payment system provided free by the U.S. Department of Treasury. By using this system, you can pay federal taxes electronically via the internet or by phone 24 hours a day, 7 days a week. Businesses and individuals can pay all their federal taxes using EFTPS. Individuals can pay their quarterly 1040 estimated taxes electronically using EFTPS, and they can make payments weekly, monthly, or quarterly. Both businesses and individual payments can be scheduled in advance. EFTPS via the internet is a secure government website that allows users to make federal tax payments. Every user must have a secure internet browser in order to access the site. To log on to the system, an enrolled user must be authenticated with 3 pieces of unique information: taxpayer identification number, EIN or SSN, EFTPS personal identification number or PIN, and an internet password. The combination of these 3 pieces of identification adds to the security of the site and the privacy of the taxpayer data. To use EFTPS, you must first enroll. To enroll, or for more information online, visit www.irs.gov and select the EFTPS link. Filing your federal tax returns is easy with Free File. If your income is less than $58,000 or less, let Free File brand name software do the hard work for you with free tax preparation and free e-filing. It's available only through the IRS.gov website, where tax software companies make their products available for free. Some also support state tax returns for free. Go to www.irs.gov and select the Free File link on the home page to take advantage of this option. Regardless of income, everyone can use online fillable forms, which are electronic versions of the IRS's paper forms. This option is best for people who are comfortable preparing their tax returns but want the advantages of fast, secure, and free e-filing. Fillable forms do only basic math and do not support state tax returns. Everyone can file their federal tax return electronically with IRS e-file. The advantages of e-file are receiving your refund in half the time, or if you owe taxes, payment options are available. Buy tax preparation software either over the counter or online. Prepare your own returns and press send to e-file. Your return is sent through a safe and secure channels, not via email. Prices do vary, so shop around, or use Free File if you qualify. Or you can find a tax professional you trust to prepare and e-file your return. It's still a good idea to tell your tax preparer you want the advantages of e-file. To file your annual federal tax return, Form 1040, you will need to use Schedule C or Schedule CEZ to report your income or loss from a business you operated or a profession you practiced as a sole proprietor. Also, be sure to include any income reported to you as a self-employed person on Form 1099 Miscellaneous. Small businesses and statutory employees with expenses of $5,000 or less may be able to file Schedule CEZ instead of Schedule C. In order to report your Social Security and Medicare taxes, you must file Schedule SE, Form 1040, Self-Employment Tax. Use the net income or loss from Schedule C or the net income from Schedule CEZ to calculate the amount of Social Security and Medicare taxes due for the year. The instructions for the Schedule SE will be helpful in filling out the form. You may use Schedule CEZ instead of Schedule C only if you had business expenses of $5,000 or less, use a cash method of accounting, did not have an inventory at any time during the year, did not have a net loss from your business, had only one business as either a sole proprietor, qualified joint venture, or statutory employee, and you had no employees, no depreciation and amortization of business expenses, you do not deduct expenses for business use of a home, and no prior year unallowed passive activity losses. Over time, a sole proprietorship may have to switch from Schedule CEZ to the Schedule C. This is usually an indication that the business has grown and now has more expenses, inventory, employees, etc. Use Form 1040 Schedule C to report income or loss from a business you operated or a profession you practiced as a sole proprietor. An activity qualifies as a business if your primary purpose for engaging in the activity is for income or profit and you are involved in the activity with continuity or regularity. Also use Schedule C to report gross receipts and expenses of your sole proprietorship, certain miscellaneous income shown on Form 1099 Miscellaneous. Since most businesses start off as sole proprietors, we're using Form 1040 Schedule C in our examples of calculating a profit or loss from a business. Schedule C is divided into 5 parts. Part 1, 2, and 3 use terms such as gross receipts, net profit or loss, net sales, cost of goods sold, and gross profit. Parts 4 and 5 ask for information about your vehicle and other expenses. In the next few slides, we're going to explain these terms. Let's begin with net profit or loss. To figure estimated taxes and to report income earned from your business, you must figure your net profit or loss. Net profit is the amount on which you pay tax. If you operated at a loss, enter the amount in parentheses. The basic way to determine profit or loss is the same for each type of business organization. You'll use this formula. Gross income less expenses equals net profit or loss. Net profit is the amount by which the gross profit is more than the business expenses for the same period. A net loss is where the cost of goods sold and business expenses are more than the gross receipts. If your Schedule C shows a profit, enter the amount on both Form 1040 and Schedule SE. If you have a net loss and all of your investment is at risk, enter the loss on both Form 1040 and Schedule SE. If you have a loss and some of your investment is not at risk, in most cases you must complete Form 6198, At-Risk Limitations, to figure your allowable loss. The at-risk rules may limit the amount of loss you can claim. The next term we're going to talk about is gross receipts, returns, and allowances and net sales. Take a look at this basic formula. Gross receipts or sales are the income that a business receives from the sale of its products or services. Gross receipts less returns and allowances equals net sales. Individuals that don't make or buy products for resale as part of their business don't have returns or allowances to deduct from gross sales. Now for the next term, cost of goods sold. Cost of goods sold is the cost to a business to buy or make the product that is sold. It is easy to figure the cost of goods sold if you sell all your merchandise during the year. However, some of your sales will probably be from inventory that you carried over from earlier years, and you will probably have an inventory left unsold at the end of the year. Note, some companies that provide services such as lawn care, web design, etc. do not have inventories and don't need to compute a cost of goods sold amount. Here's another formula for you. To figure the cost of goods sold, start with the cost of the inventory on hand at the beginning of the year. Add the cost of additional goods purchased or manufactured during the year. Be sure to subtract the cost of any merchandise withdrawn for personal use, such as food a grocer may take at home, or gasoline a garage owner may give to his relatives. The result is the cost of items available for sale during the year. Then subtract the value of your inventory at the end of the year. Your cost of goods sold is the remainder. Some businesses may choose to keep a continuous or automated inventory system, but no matter how you choose to track it, you need to keep good beginning and year-end inventory records. Now we're going to figure gross profit. Here comes the final formula we're discussing today. Beginning with gross receipts, subtract your sales returns and allowances and the cost of goods sold to determine gross profit. And again, we note a sole proprietorships that are service companies don't need to deduct cost of goods sold amount to complete their gross profit. Let's go into more detail about common business expense deductions. We'll start with travel, transportation, and entertainment. These deductions are common to all types of businesses. We'll take a look at each type in the following slides. Travel expenses are the ordinary and necessary expenses for traveling overnight away from home in the course of your trade or business. These expenses include the cost of public transportation, operating and maintaining your car, meals, lodging, and other related expenses. You can deduct the actual cost of meals or use a standard per diem rate. See Publication 463 for the latest per diem rates and detailed information about your travel expenses. Transportation expenses are the ordinary and necessary expenses of getting from one workplace to another in the course of your business or profession while you are not away from home. Commuting expenses are not deductible. Exactly what are commuting expenses? You cannot deduct the cost of taking a bus, trolley, subway, or taxi, or of driving a car between your home and your main or regular place of work. These costs are personal commuting expenses. You cannot deduct commuting expenses no matter how far your home is away from your regular place of work. You cannot deduct commuting expenses even if you work during the commuting trip. For example, you sometimes use your cell phone to make business calls while commuting to and from work. Sometimes business associates ride with you to and from work, and you have a business discussion in the car. These activities do not change the trip from a personal to business. You cannot deduct your commuting expenses. If you use a car for business only, you may base your deduction on the full cost of operating it. If you use the car for both personal and business purposes, you must divide your expenses between those uses on the basis of mileage to compute a business percentage. Do not include commuting to and from work as business mileage. You may take a deduction for your actual business expenses for the car or use a standard mileage rate. Standard mileage means multiplying your business mileage by a standard rate. For this year's rate, check the IRS website. However, to use the standard mileage rate on a vehicle after the first year of business use, you must have used the standard mileage rate for the first year. In later years, you can alternate between standard mileage and actual expenses. This alternating option is not available to you if you claimed actual expenses in the first year of business use. Actual business expenses include gas, oil, repairs, insurance, depreciation, tires, and license plates. Under either method, parking fees and tolls are deductible. See Pub 463, Travel, Entertainment, Gift, and Car Expenses for more information on using standard mileage rates and the use of a car in your business. Business entertainment expenses are deductible only if they are ordinary and necessary expenses of carrying on your trade or business. In order to deduct these expenses, you must maintain receipts and records. This includes taking your clients to lunch. Publication 463 explains the 50% limits on business meals expenses. If you buy property for use in your business that has a life of more than 1 year, you may deduct its actual costs or other basis over a number of years. This practice is called depreciation. Do not depreciate land, inventory, or property you placed in service and disposed of in the same year. You can depreciate property that meets all of the following basic requirements. The property must be used in business or held for the production of income, have a determinable use of life longer than 1 year, and be something that wears out, decays, gets used up, becomes obsolete, or loses value. The method for depreciating most tangible property, that's the property you can see or touch, is the modified accelerated cost recovery system. It's commonly referred to by its initials MACRS and pronounced makers. Under Section 179 of the Internal Revenue Code, you can elect to recover all or part of the cost of certain qualifying property up to a limit by deducting it in the year you placed the property in service. You can elect the Section 179 deduction instead of deducting the cost over several years through depreciation deductions. Publication 946, How to Depreciate Property, explains all about makers and Section 179 deduction. It explains what property qualifies for the Section 179 deduction, what limits apply, and how to elect it. Let's talk about an expense that is always in the news, health insurance. The Small Business Jobs Act of 2010, subject to specific statutory limitation, allows business owners to deduct the cost of health insurance for themselves and their family in the calculation of their 2010 self-employment tax. We are not going to get into detail about health care expenses as this issue is still evolving. However, for additional information on this subject, go to www.irs.gov and type in the search words Small Business Jobs Act of 2010. It will bring up a link to the Small Business Jobs Act of 2010 Tax Provisions webpage. Section 2042 explains the credit and Form 1040 for 2010 Schedule SE and its instructions explain how to calculate the credit. The Small Business Jobs Act of 2010 has also increased the amount a taxpayer is allowed to elect as a deduction for startup expenses under Section 195B for taxable years beginning after December 31st, 2009. The remaining balance of startup expenses is deducted proportionately over 180 months on Form 4562, Depreciation and Amortization. For the latest information on these expenses and credits, visit www.irs.gov. The next topic we need to discuss is record keeping. You must keep receipts, sales slips, invoices, bank deposit slips, canceled checks, and other documents. These documents, either electronic or paper files, can substantiate items of income, deductions, and credits. Keeping these records will help you pay only the tax you owe. Unless you have records showing the sources of your receipts, you may not be able to prove that some are non-business or non-taxable. You need good records to monitor the progress of your business. Good records can show whether your business is improving, which items are selling, or what changes you need to make. Good records can increase the likelihood of business success. You may forget expenses when you prepare your tax returns unless you record them when you pay them. You need good records to prepare accurate financial statements such as profit and loss statements and balance sheets. These statements can help you in dealing with your bank and creditors to establish your earnings from self-employment. Your records should show the amount of earnings reportable for self-employment tax purposes. If the IRS audits your income tax return, you may be asked to support the entries on your return with sales slips, invoices, receipts, bank deposit slips, canceled checks, and other documents. These items of support are necessary for you to have adequate and complete records. Visit the IRS video portal at www.irsvideos.gov to see in-depth presentations on record keeping. The portal also features a great series titled Your Guide to an IRS Audit. This series of videos takes the viewer through the steps of an audit from notification to closing. Also, be sure to safeguard your records to prevent theft or loss due to natural disaster. We'll talk about this more now. In case of a disaster, planning is an important part of safeguarding your records. Being able to access your records will help you resume business operations quicker. Take advantage of paperless record keeping, including filing your returns and paying your taxes electronically. Additionally, many people retrieve bank statements and other documents online, an excellent way to secure financial records. However, we encourage you to download your bank statements on a regular basis. Be sure to back up your electronic files and store them in a safe and separate location. You can periodically copy them onto a CD, flash drive, or other electronic storage device and send it to a trusted person in another location for safekeeping in case your normal computer backup systems are destroyed. Also, many retail stores sell computer software packages that you can use for record keeping. You should also document valuables and business equipment. One option is to photograph or video the contents of your home and business, especially items of great value. You should store this documentation with someone outside your geographic area to reduce risk. The IRS has disaster loss workbooks for individuals, Publication 584, and businesses, Publication 584B, that can help you compile a room-by-room list of your belongings or business equipment. This will help you recall and prove the market value of items for insurance and casualty loss claims if needed. How quickly you get back to business after a disaster often depends on emergency planning done today. Start planning now to improve the likelihood that your business will survive and recover. When starting a business, you must determine a business structure. In this webinar, we're focusing on the sole proprietorship. If you are a one-person business, you're automatically classified as a sole proprietor for federal tax purposes unless you file Form 8832, Entity Classification Election, to request a different classification. A sole proprietorship is an unincorporated business owned by one person. It is the simplest type of business organization. The business does not exist apart from the owner. The owner assumes risk of the business to extend all of their assets, even if they don't use their personal assets in the business. Usually, the ability to finance the business, known as capital, is limited to the amount the owner can come up with. This may limit the expansion of a business when new capital is required. A common cause of failure for sole proprietors is the lack of capital. The exception to a sole proprietorship being a one-person business is a qualified joint venture. We're going to talk about that now. So what is a qualified joint venture? It's when both spouses have an equal say in the affairs of the business, provide substantially equal services to the business, and contributes capital to the business. This used to be called a partnership. Now spouses can elect to be treated as a qualified joint venture. A qualified joint venture is a joint venture involving the conduct of a trade or business if the only members of the joint venture are husband and wife, both spouses materially participate in the trade or business, and both spouses elect to have the provision apply. Materially participation means working on a regular, continuous, and substantial basis in the business. In a qualified joint venture, all items of income, gain, loss, deduction, and credit are divided between the spouses in accordance with their respective interests in the venture. Each spouse takes into account his or her respective share of these items as a sole proprietor. For the purposes of determining net earnings from self-employment, each spouse's share of income or loss from a qualified joint venture is taken into account just as it is for federal income tax purposes. This generally does not increase the total tax on the return, but it does give each spouse credit for Social Security earnings on which retirement benefits are based. Spouses make the election on a jointly filed Form 1040 by dividing all items of income, gain, loss, deduction, and credit between them in accordance with each spouse's respective interests in the joint venture. Each spouse files a separate Schedule C and Schedule SE with their Form 1040. A business owned and operated by the spouses through a limited liability company does not qualify for the election. Only businesses that are owned and operated by spouses as co-owners qualify for the election. If all this sounds too complicated for you, consider finding a tax preparer to assist you in filing your federal tax return. However, you are legally responsible for what's on your own tax returns, even if they're prepared by someone else. Here are a few points to keep in mind when someone else prepares your return. Avoid preparers who claim they can obtain larger refunds than other preparers. If your returns are prepared correctly, every preparer should derive substantially similar numbers. Beware of a preparer who guarantees results or who bases fees on the percentage of the amount of the refund. A paid preparer is required by law to sign the return and fill in the preparer area of the return. The preparer should also include their appropriate identifying number on the return. Understand that most reputable preparers will request to see your receipts and will ask you multiple questions to determine your qualifications for expenses, deductions, and other items. By doing so, they have your best interest in mind and are trying to help you avoid penalties, interest, or additional taxes that could result from an IRS audit. Review the completed return to ensure all tax information, your name, address, and Social Security number is complete and correct. Review and ensure you understand the entries and are comfortable with the accuracy of the return before you sign. Never sign a blank return and never sign in pencil. Unfortunately, unscrupulous tax return preparers do exist and can cause considerable financial and legal problems for their clients. Consider whether the preparer has any questionable history by asking questions and getting references from other businesses. Report suspicious actions by tax professionals to the email address of the IRS Office of Professional Responsibility. The email address is opr@irs.gov. There are online learning tools available on the IRS video portal. The portal contains video and audio presentations on topics of interest to small businesses and individuals. A virtual small business tax workshop is also housed on the IRS video portal. The workshop is composed of 9 interactive lessons designed to help new small business owners learn their tax rights and responsibilities. www.irs.gov is also an indispensable resource for information you'll need to meet and comply with all your federal tax obligations. Now let's review what we've talked about. A sole proprietor is someone who owns an unincorporated business by himself or herself. Self-employed persons pay self-employment tax and pay their taxes quarterly by making estimated tax payments. Generally, use your Social Security number as your taxpayer identification number. However, you might have to apply for an employer identification number in dealing with other businesses, including banks that require an EIN to set up business accounts. EFTPS is a free, secure way to pay all your federal taxes. If your income is $58,000 or less, use FreeFile, brand name software, to complete your federal tax return and e-file for free. Regardless of your income, everyone can use IRS online fillable forms and e-file for free. To file your annual Form 1040 federal tax return, you will need to use Schedule C or CEZ and Schedule SE. We talked about the formulas for figuring net profit or loss, net sales, cost of goods sold, and gross profits. We discussed 3 common expense deductions: travel, transportation, and entertainment. We briefly defined depreciation of business property. We explained the importance of good record keeping. Qualified joint ventures were discussed. Husband and wife businesses can elect to be treated as a qualified joint venture instead of a partnership. And finally, we discussed tips on selecting a tax professional to prepare your federal tax return if you don't feel you can do it yourself. This concludes the video portion of the webinar, and we thank you for watching. Please send us your questions by selecting the Ask a Question link under the PowerPoint window and then select the Submit button. Subject matter experts will soon be answering some of your questions. Please stay tuned.
Hello, I'm Diane Cole. I'm here today with David Tracewell and Marisha Heilman. We're all 3 senior exam policy analysts for the Small Business Self-Employed Division of the IRS. David and I will be answering your questions that you submitted during the program, and Marisha will be handling the email for us. We hope you found the webinar helpful and informative. So now let's find out what kinds of questions are on your mind. Our first question is this. So submitting quarterly tax payments, what if you don't take a regular paycheck but take a draw from time to time? Well, that's common, especially when you first start out. If you look under the rules for estimated tax payment, it says you generally make estimated tax payments if you expect to owe taxes, including self-employment tax of $1,000 or more when you file your income tax return. If you do not make estimated tax payments, you can pay any tax due when you file your tax return. So if it's under $1,000, you can pay that at the time you file your tax return that's due in April. Dave, will you take the next question?
Certainly, Diane. Thank you. We have a question. If I start a business while still employed by someone else, how do I handle the miles driven to and from my own business? If I go home from my main job to change clothes and drive to a customer site, is that business miles deductible? We've had several questions in that area. The transportation expenses that are ordinary and necessary expenses of getting from one workplace to another course in your business is generally subject to deductibility or the standard mileage or using the calculation of the actual mileage or actual expenses calculations. It said, what about the weekend mileage? Again, if you're self-employed, there's no distinction on your business. You know, you could work 24/7. So therefore, the miles driven in your ordinary and necessary expenses of getting from one workplace to another would be deductible. Diane?
To answer this particular question, it says, can you deduct cell phone and Internet expenses as a sole proprietorship? The answer is yes, as long as they're used in your business and they're ordinary and necessary. Maybe some of your Internet, if you use it also for personal, you might want to allocate the personal versus the business use along with the cell phone usage. But, yes, you can deduct those. And since that's a short one, Dave, I'm going to go ahead and take this next one.
Okay.
And it is, if qualified joint venture filers must file separate C and SC forms, does that mean they must also file separate 1040 forms? That is an answer, no. If they're filing a joint return, they're going to file their individual Schedule C and Schedule SEs per spouse, but they will put those together and put them on the Form 1040. Dave?
We have another question here. How long are we required to keep business records? And that's an important question, and the answer kind of depends. The IRS generally has 3 years from the filing date to examine a tax return, and that this is called the statute of limitations. If you discover an error, you generally must file your claim for credit or refund within 3 years after the date you filed the original return, or within 2 years after the date you paid the tax, whichever is later. Generally, the tax records must be kept at least until the statute of limitations expires for the tax return on which any of those items of income, deductions, or credits appear. This type of item being documented and expensed may also have a bearing on the length of time that the record should be maintained. Maintaining records for the period required will assist you when you discover a mistake on your return and need to file an amended return or claim for refund. If the expenditure does involve a capital asset, usually the item receipts should be kept as long as the equipment or asset is maintained. Diane?
Change the speed here. Here's one that says it sounded as though an SE, self-employed person, should be filing even if the business suffers a loss. Is that true? Generally, if you have a net operating loss for a tax year ending in 2010, you must carry the entire amount of that loss back 2 years and then go forward 20. If this is your only income, which the question did not state that, but if this is your only income, you still should be reflecting that, the loss. Go ahead and file your Schedule C or in SC showing the loss, but attach that to your Form 1040.
We have a question here concerning if a sole proprietor has employees but are giving them a 1099 miscellaneous, are they required to get an EIN, or may they use their SF Social Security number? If they have the employees, they should be issuing a W-2 and would have to have an EIN. So I guess the bottom line answer is they need to get an EIN for this.
Next question, is it mandatory that I pay quarterly taxes if I have yet to make a clear profit with my business? No, you do not have to file a zero return, a quarterly return for your estimated tax payments. You do that, you reevaluate what you make as the year goes by quarter, and start estimating what your profit is. If you get to the end of the year and have yet to pay in any estimated tax payments, you can then evaluate it and pay that in on your 1040, your annual tax return.
We have a question here. What is the maximum amount of self-employment income subject to self-employment tax? There is a change from 2010 to 2011. In 2010, the tax year that just wrapped up, the maximum net earnings from self-employment subject to Social Security part of the self-employment remains at $106,800 at the 12.4%. For 2011, the rate is reduced to 2% to 10.4 on the first $106,800 of combined wages, tips, and net earnings.
Question was received. Please kindly advise what is the adjustment to the taxpayer's Form 1040 when he did not sell his ending inventory upon closing his Schedule C small business? There's not an adjustment. There's not enough detail into this question, but once you do sell those, if you later down the road sell those, you need to report those on a Schedule C in subsequent years.
We have another question on the Form 1099 miscellaneous. When payments of $600 or more for services performed for your business by people not treated as your employees, such as fees to subcontractors, attorneys, and accountants, a 1099 miscellaneous is required. If the payments are made to a corporation, then the 1099 miscellaneous would not be required to be issued.
Question is, I have 3 businesses. Can I file only one Schedule C and only one SC? No. We want all 3 of those businesses to be reported separately on its own Schedule C, because we are also going to request that you put the codes in there for what type of business it is. You can, however, use one Schedule SE to calculate the self-employment tax. So 3 Schedule Cs in this situation for the 3 businesses and 1 SC schedule.
We've had a general question on what are the business expenses that can be deductible. Usually you can deduct expenses on your business expenses on the Schedule C that are the current operating costs of running your business. To be deductible, a business expense must be both ordinary and necessary. An ordinary expense is one that is common and accepted in your field of business, trade, or profession. A necessary expense is one that is helpful and appropriate for your business, your trade, or profession. An expense does not have to be indispensable to be considered necessary.
Question, do I have to have a federal ID number if I set up my own home-based business, no employees planned? Generally, that is no. You do not have to have a federal ID number. When you would use that is if you had employees. Unless you need one to set up a bank account, some banks require a federal ID number.
We had a question, is there a minimum amount you may make before being required to file Form SE? You must file Form SE if your net earnings from self-employment are $400 or more.
How do I estimate my income quarterly when I don't know how much I will make over the year? You will estimate that as you go. At the end of the year, at the end of the quarter, you look back at what your income has been and determine whether or not you should be sending in estimated tax payments. We apologize for the delay. Several of these questions that have come in are very similar to the ones that we've already addressed. So just bear with us as we read through some of these. Dave?
If you receive a 1099 miscellaneous for income from part-time work and have no expenses, do you need to complete a Schedule C, or can the income just be directly entered on the 1040? A Schedule C or a Schedule CEZ would be required to be filed. Again, plus along with potentially the Form SC self-employment tax if it's $400 or more.
I had a business that I did not operate last year because of illness, but resumed business this year. Do I file a Schedule C for last year? I do have machinery that I have been depreciating the previous years. So, no, you would not be filing a Schedule C for this past year that you did not operate. And when we say not operate, that you did not operate from January 1st through December 31st if you're a calendar year taxpayer. Now, as far as depreciating the asset, the machinery, you would not continue depreciating it. You only depreciate or claim a deduction for depreciation if the asset was used in a business. So it wasn't. So when you resume your business, starting, I'm assuming, January of 2011, let's say, then you can put it on, depreciate your machinery on next year's tax return, on your 2011 tax return. I hope that answered what you were asking.
I have a question here. Please clarify, the income I earn from a full-time job is taxed separately from the income earned from self-employment. So my full-time salary does not affect taxes owed on self-employment. No, the amount of salary earned on a full-time or part-time job would or could affect the amount of self-employment taxes owed.
Regarding the law that was passed giving a temporary payroll tax cut in 2011, will it also benefit the self-employed, i.e., will the SE tax be lower this year for the self-employed? No. You're still going to spend a total of 15.3% on your net self-employment earnings that will be subject to Social Security and Medicare up to $106,800 for the year 2010 and 2011, and then you'll continue to pay that 2.9% for the Medicare part of the SE tax.
I have a question. Do I have to file a return 941 or 940 if they had no payroll for the year? If there were no salaries or federal withholding withheld, there would be no 941 form required. If I understood that correctly.
We want to get to the last question. We're getting close to the end of our question and answer session, so we have time for this one last question. And that question is, how much can I deduct for meals and entertainment? Is it 50% or 100%? And it is limited. You can deduct the cost of meals and lodging if your business trip is overnight or long enough that you need to stop for sleep or rest to properly perform your duties. So in most cases, you can deduct only 50% of your meal expenses when you're in travel status during business or in your trade or business. That also pertains to the entertainment expenses, that you can deduct 50% of those business-related entertainment expenses for entertaining a client, a customer, or employee. And those type of expenses include like taking these guests to nightclubs, athletic clubs, sporting events, providing meals to these customers. So that is not 100%, but it is 50%. That's all of our questions for today. We want to thank all of you for watching our webinar today. We hope you learned a few things about what it is to be self-employed and what's involved in meeting your tax obligations as a self-employed person. If you have any questions that are not answered today, please visit our website at www.irs.gov for more information and answers. We thank you again for your time and attendance. We hope you have a great day, and more importantly, we wish you success in your business. Thank you again.